Alright, once again, good evening and welcome to the session. Now, this evening we're going to discuss credit administration, in which we're going to see some conditions that the borrower or the customer needs to fulfill just before the loan has been disbursed and also right after the disbursement of the funds. Likewise, we're going to cover some issues related to trade, sales, and overtrading. Now, loan approval are subject to a number of terms and conditions which need to be fulfilled before disbursement of the funds. These terms and conditions are given in the so-called an offer letter or credit agreement. When the borrower enters into a contract with a bank, okay, then the bank needs to ensure that there is a contract signed or an agreement signed. Therefore, the agreement, which is lawful, is termed as offer letter or credit or loan agreement. Now, there are some conditions which the borrower needs to fulfill before the funds have been disbursed, and also conditions that the borrower needs to fulfill right after the loan has been disbursed. Now, these are pre-disbursement condition and post-disbursement condition. The pre-disbursement condition refers to all those conditions that must be met before funds are disbursed to the borrower, before funds are at the disposal of the borrower. Okay. Conversely, there is post-disbursement condition, meaning that these are the conditions that the borrower needs to adhere to during the entire tenure of the loan until he completely repay back the entire loan and its subsequent interest. Then he will be excused from fulfilling the post-disbursement condition. Right? Therefore, post-disbursement condition, these are right after they come into play, right after funds have been disbursed to the borrower. That means funds are at the disposal of the borrower. And pre-disbursement condition, it means funds are still at the disposal of the bank. Now, the terms that must be met before funds are released to the borrower are such as submission of title documents. Remember, when we're analyzing the loan, at one point in time, we're going to need security, for example. Okay, and security, once submitted, okay, some of the security actually are immovable. So what do we need? We need the title documents to be submitted to the bank. And this is very important because if you do not take title document, then at the end of the day, remember, we're supposed to do what we call perfection, okay, of security, which involve execution and registration of the security. Now, without securing title documents, the customer might be tempted to go somewhere else and use exactly the same security as a cover or a collateral for a loan, which will bring some legal problems just in case this customer defaults along the way. Again, the moment you have received this document, you need to execute this document. This is what I highlighted earlier, perfection with the security. The title documents needs to be executed. That means there are some legal procedures that needs to be fulfilled at the relevant law authorities. So you need to do so before you store these documents into the so-called credit file. Then the collected documents, again, if the title of the documents needs to be registered. For instance, if we're talking of the landed property, then land registrar in case of landed property in our country. Again, you need to ensure that there is no pending litigation in the security so pledge, okay? Because there can be some conflict between shareholders, conflict between family members, conflict between individuals, etc. Okay, so a bank is not supposed to accept a security that has some issues. And to be precise here, some legal issues. The security needs to be clean or neat. Okay, it needs to be as white as snow. Again, if, for instance, the borrower or the prospective borrower is a company, then you need to ensure that the company has submitted relevant documents that prove that individuals that you as a banker is dealing with have a borrowing authority. So please do not forget to ask for MEMAT. And the moment you receive Memorandum of Association and Article of Association, go through the Article of Association in order to know powers of management of the company, the powers of directors, CEOs, etc. Okay, MEMAT can give you a hint about powers of those individuals. Remember, if you are dealing with an individual who is not qualified to enter a company into a contract, this kind of contract, then in case of a default, you will have nowhere to run. Now, the next conditions are known as the post-disbursement condition. The post-disbursement condition simply means the condition that will continue to be adhered by the customer or the borrower during the entire tenure of the loan. Basically, these conditions arise right after funds have been disbursed. Okay, right after fund has been disbursed to the customer, meaning that funds are no longer at the disposal of the bank but are in the hands of the customer. Therefore, the bank needs to ensure that these funds somehow continue to be safe. For instance, now, to ensure that this fund is safe and the loan will be fully repaid, we need the customer to route sales proceed through the bank account. Okay, that way we can monitor even the account turnover, etc. Again, the customer needs to submit agreed periodical documents such as stocks and debtor statements, management accounts, etc. All right. Again, the customer needs to pay statutory charges and fees. Okay, for instance, if the asset that serves as security for the loan is a rented property such as a plot, then there is so-called land tax. This customer needs to pay this, or property tax for buildings, etc. Again, there are some taxes, some other taxes, as well as we need to ensure that on a yearly basis, this customer brings to the bank a tax clearance. It's very important because in case of a default, a bank cannot go hand to hand against regulatory authority. Therefore, we need to ensure that we safeguard the bank position at all times. We need also to ensure that the customer pay insurance premiums as required. The moment an asset has run out of insurance, he needs to renew the insurance by paying the required insurance premium. Why? Because the bank needs to ensure that the asset in question is safe all the time, and in case it suffers damage due to reason that are insured, then the insurance company can intervene and cover that loss. So this is what we call risky transfer. Now let's see loan documentation. Loan documentation refers to the documents needed to legally enforce the repayment of the loan. These documents are supposed to stand by themselves before the court of law. So they need to be prepared professionally to ensure that in case of any dispute, they can be used to the court by any individual, not necessarily a credit officer who initiated or disbursed the loan. Okay, they need to be used by anybody before the court of the law. Therefore, a document such as the loan agreement itself must be perfect in all aspects so as to be enforceable in a court of law. Now, some common documents that we need to have in the loan documentation or a credit file are such as the loan contract, collateral agreement, guarantees, financial statements, projected cash flow statements, and appraisals. These are very important to be there. Why? For instance, projected cash flow is submitted by the customer before we disburse the funds. Now, when we come to evaluate the loan, we need to compare projected cash flow against actual cash flow. All right. This one can tell you on whether the customer is doing fine or is not doing fine. Appraisal, just in case the loan goes bad, you need to rehabilitate the loan or to decide to recover the loan. Now, how will you rehabilitate the loan if at all you don't even know how it was appraised? That's the reason we need the appraisal procedure also to be included in this particular credit file. Guarantees, that is a guarantee contract between a bank and another individual, a third party, who guarantees or who pledge to pay the bank just in case the principal borrower default from the contractual obligation. Okay, collateral agreement. This is some kind of a contract that a customer sign to pledge their assets to serve as collateral for the loan or security for the loan. Right, and loan agreement now covers all those issues. Some other documents that can be contained are such as the promissory notes, guarantees, loan agreement, collateral. Okay, and all these documents need to be very well prepared, very well signed, and then you submit them. Financial statements must be received and analyzed in a timely manner. And now, how are you going to analyze financial statements? Okay, what we do is we use what? Ratios. Right? So you can compute ratios such as liquidity ratios, profitability ratios, gearing ratios, and activity ratios. These ratios can give you a picture of the financial soundness or healthy of such a business or a company. All right. Again, collateral needs to be registered with appropriate jurisdiction. Okay. Registration of collateral is very important to prevent the very same collateral asset to be used somewhere else to support a loan. Now, all these documents are kept in the so-called credit file. The credit file is the control point for loan documentation. In case of anything, we can just go back to the credit file and pull out whatever we want or any information from the credit file. Now, depending with your bank or institution, a credit file can be prepared manually or electronically, depends on the institution. All documents in respect of the borrowing customer must be filled in the respective credit file. Okay, so every single loan needs to have its credit file where we keep all these documents. Now, in case you open a credit file of a customer, what should you expect to find there? Number one, application for the credit facility. It's very important to establish that who really initiated or originated the loan. This is loan origination. And always we want the customer to be the one to originate the loan. Without these documents, a customer might say that he never even asked for the loan in the first place. Okay, maybe you guys, you bankers, were the one who forced the customer to apply for a loan while he never had a plan for it. Okay, so in case of such accusation or allegations, you can go back to the credit file and show the customer that this is the facility letter that you wrote to the bank asking or requesting the bank to grant you such facility. So you are the one who actually originated this particular loan. Again, during the loan appraisal, we usually investigate and we collect some other information from the credit bureau, for instance, the CRB. Therefore, the report from CRB needs to be kept in the very same credit file. Copies of loan documents such as promissory notes, security agreements, loan agreement, and financial statement also needs to be there. Financial statements that were submitted need to be kept in the very same file. Copies of any committee meeting minutes related to the approval, modification, or retention of the security again should be kept. So it depends actually with the type of the borrower who approaches your bank asking for a loan. All right. In case there are some conference calls or some calls, some memos written, etc., also needs to be kept in the very same credit file. Memoranda on premises visits, collateral inspection, and appraisal of the management of the company or business that was looking for a loan. All those information again should be kept in the credit file. Now, we have issued the loan. The money is now at the disposal of the bank. What else? You need to keep constant monitoring of the loan. Okay, so here is where some bankers made a mistake. That is, the moment you issue the first loan, you run away looking for a second, third, and fourth customer who you can as well issue loan in order to increase your portfolio, and you forget everything about the first customer. And what exactly do you forget? You forget to monitor the progress of this customer. Okay, so sometimes these customers default not because of their own mistakes. Sometimes we bankers are the reasons for high rate of default because we don't keep track of our customers. We don't go to visit them, to revisit their business. We don't go to talk to them. We don't even advise them on what to do in order to continue improving. Okay, so that way the customer might be tempted to use or to misallocate funds, to misappropriate funds, or the customer might end up doing something different which was never even apprised for such a loan. Loan account monitoring is everlasting. That means it will stop the very same day the entire loan has been fully amortized. Okay, so why do we monitor? We monitor in order to oversee or to enforce compliance of the terms and conditions of the loan. Okay, that is what we do. Look, even in a country, okay, the parliament passes law, right? Judiciary translates this law, but who enforces the law? Police. Okay, so basically loan account monitoring here, we're discussing about policing, all right? Policing of the terms and conditions. Terms and conditions will never work if you are not there to police them. Okay. The interest of the creditor is to observe the way the credit account is being operated by watching aspects such as disbursement or withdrawal. Remember, under the post-disbursement condition, for instance, we ask the borrower to ensure that all sales are routed through our bank. Okay, through our bank. That means this individual customer needs to have a current account in our bank where all payments will be done into this account. Therefore, you can monitor the account first by watching disbursement or withdrawal from that account, repayments or deposits, usage of funds. Now, loan accounting must be accurate recording and everlasting process. Monitoring is an ongoing exercise where important events are diarized in order to check compliance. And in case you come across anything that raises your concern, please do not hesitate to talk to the customer or to take appropriate measures, because it's much better you prevent the customer from a total fall rather than waiting for the customer to fall so that you can go to realize the borrowed funds from selling of the securities. It's extremely difficult to realize your fund from selling the securities. The lender should make regular visits to the business premises to ensure, among other things, that the business is operating as usual. Remember, you visited this business before you disbursed the funds. You took some pictures, for example, or you have a very good memory. You write some stuff in your diary about that business. Now that you have granted the requested loan, for instance, the customer asked such a loan in order to replenish, in order to add some more stocks or inventories in the business. Now, Do you see any new additions in the business shelf, or the shelves are empty? Again, are all assets intact and well maintained? Because remember, these assets also, some of the assets have been pledged to serve as collateral, or in case of debenture, for instance. A debenture can be charged on floating assets as well as fixed assets. That then we have fixed debenture and floating debenture. Okay, so you need to ensure that all assets of the business are very well maintained and are in good condition at all times. Okay, and what about working environment? Is the working environment conducive? Are employee very happy? Are they getting paid on time? Are there some issues of concern? Is there some issues such as trenching, etc.? Okay, talk even to employees. If it's a supermarket, just go around, pretend as if you want to buy something, or you're looking for a certain item that you cannot find. But what you are doing is you just go around to see if there are some significant changes that should warn you about a potential collapse or a potential default. If everything is fine, then all right, you continue looking for other prospective borrower, but also you do not forget to continue monitoring this particular borrower. Again, the lender should ensure that the account operates within the limit, particularly if we are talking of the overdrafting facility. Funds are being used for the purpose agreed. Remember, when the customer comes to ask for a loan, we ask him, what is the purpose for the loan? And let's say the customer replied, to replenish or to add some new stocks or inventory in my business. Okay, now, has he added some more stocks in the business, or he went on to purchase a motor vehicle? Okay, so you need to ensure that everything has been added. Again, if there are some assets pledged as the collateral, ensure that they have insurance cover, premium is paid, and is up to date. In case the insurance expires, it needs to be renewed right away. Ask the customer to submit reports on regular basis. Okay, now what are the reports? Can be financial statements, management accounting, etc. Now, periodic these reports can be submitted, let's say, on a monthly basis, on a quarterly basis, semi-annual, or on annual, depending with how you credit officer has decided to make it. In case of the management of the business, there should be no material change, because sometimes a bank can offer the loan not only based on the qualities of other aspects of the company, but also the qualities of the management team. And sometimes it might happen the management team does not concur 100% with shareholders. All right. Therefore, if the bank has full faith in the management team, then the management team needs to be there during the entire tenure of the loan. All right. Therefore, in case of any changes, you need to be alarmed, because it might bring some problems. The purpose of monitoring and evaluation is to take control of the situation before it gets out of hand, because a person does not just wake up in the morning and default. There are some hints, okay? There are some issues that will be happening that can give you an insight of what is about to happen, the impending problem, right? Therefore, through monitoring and evaluation, you will get to know what is about to happen, and probably you will advise accordingly, or you'll be part of the rescue team. Remember, we really love someone to be proactive rather than active. Okay, selling assets that we are pledged to serve as the collateral in order to recover bank's fund, that is being active. But basically, you're supposed to be proactive to prevent the problem from happening. That's how the best we expect you to be. Compare those observations, which are the actual position of the account in a particular point in time on the ground, with what has been agreed or planned for the specific period. Remember, you ask this customer to submit a number of reports or documents. Therefore, for instance, compare projected figures against actual figure. The customer submitted to you projected cash flow, claiming that if you give him the loan, maybe he'll be making as a profit, let's say, at the end of the month, 10,000, okay, every month. Now, compare the projected figure against actual figure. Is he really making 10,000? Is he really making something bigger or something small than 10,000? Then what is the problem? And what can be done in order to correct the problem? And what about loan repayments? Okay, repayments are scheduled. Now, does the business meet the scheduled repayment? Ensure that agreed terms and conditions of the loan agreement are being complied with by the customer. I think you remember covenants. In case there is an issue of major concern which may jeopardize the repayment of the loan, the lender must discuss the matter with the customer and find out what went wrong with the first proposal, because before you disburse the funds, you apprise the loan. Okay, that was the first proposal. The customer brought the proposition, you applied the loan, and after the appraisal, you were satisfied and decided to issue the loan. Now, what's happening? Why this customer is about to default? Why this customer is facing some problems? Sit down with the customer, discuss it in order to arrive to the better conclusion on what should be or should not be done. Make a visit to the customer's premises in order to see if the business is still there, okay, if everything is intact, or if there are some material changes that might be the reasons for the impending default. Now, reassess the business. Okay, remember, you accept this business in the first proposal. Now things are not going as planned. Reassess the business. You can use 6Cs or you can use company or any other learning assessment model at your disposal. Always check adequacy and effectiveness of the security and keep controlling office informed. Okay, I think you are aware that BOT requires a security to cover the loan by 125%. Okay, now in case there are some issues, okay, with the loan, the bank have two options. Number one, to rehabilitate the loan, or number two, to recover the loan. What do we mean when we say rehabilitate the loan? Of course, the bank does not want to terminate this relationship with its customer. As a matter of fact, the bank wants to be part and parcel of individual or institution that assisted the customer to grow. Therefore, in case the customer is in trouble, sit down with the customer, reassess the loan, and come out with some solution. What can be done for the customer to continue servicing the loan? This is the meaning or the essence of loan rehabilitation. Okay, continue with the banking relationship only if the position of the customer is considered acceptable and can be corrected. Okay, if the position of the customer is not acceptable or it's difficult to correct, then it's much better you breach the contract and recover the loan through selling of the asset. Now, if the condition of the customer is acceptable and can be corrected, then what do? Restructure the loan and issue a new credit agreement. Now, in this new credit agreement, you will have to revise those terms and conditions. Remember the covenants that you brought to the customer in the first appraisal. Okay, now what went wrong? Why this customer is about to fail? Why is he facing some difficulties? Okay, so you can add some more conditions in order to ensure that the customer will play within the boundaries set forth by the bank, and that way you'll be safeguarding bank funds. Depending on the new analysis and agreement with the borrower, possible things to be done include the following. You can modify the loan tenor. Okay, for instance, if the loan was supposed to be completed within 3 years, okay, you can increase the tenor from 3 years to 5 years. Okay, now what is the effect of adding some more years? Okay, now the effect is that the loan repayment, okay, the periodical repayment will decrease. So it will be affordable for the customer to make this periodical repayment. For example, if within 3 years, the monthly repayment for this loan was supposed to be, let's say, 5,000 USD, when you add some more years for the customer to repay the loan, then this amount won't no longer be 5,000. Maybe it will be somewhere around 2,000. Okay, depending with the interest rate and other factors. This is just a hypothetical example. Okay, so the point here is that if you increase the duration of the loan, the monthly or periodical repayment of the loan will be somewhat lower than the previous repayment. So that way the customer can afford to pay. Or you can alter the interest rate. Depending with the prevailing interest rate condition, you can alter the interest rate. Again, the bank can decide to defer principal and interest payments depending with the agreement between the bank and the customer. Remember, we are doing all this in order to continue a banking relationship with this customer. Now, if you have come into conclusion that there are some assets in the possession of the customer that are withdrawing funds from the business, okay, assets such as used motor vehicles or motor vehicles that have been with the customer for quite some time, okay, and they are almost old. Every time they need to be repaired, those assets need to be disposed. Okay, if there are some buildings that require massive maintenance all the time, again they should be disposed. So advise the customer to dispose unnecessary assets. And again, since you have increased tenor of the loan, it's much better you ask for additional collateral, because additional collateral can assist you to safeguard the bank fund just in case there is a problem. Now, what if the customer or the bank has come into conclusion that there is no point to continue business relationship with this customer? What you have to do is to recover the loan. Alright. Legal action should only be taken as a last resort, and if all effort to recover prove futile, because here there is some reputation risk, and we need to avoid the reputation risk again at all costs. The lending banker needs to be aware that this process is costly, time-consuming, and can lead to a loss of reputation. This is what I said about reputation risk. Time-consuming is because sometimes you take an asset to the market and it does not realize even a fair value price. So you cannot just sell it, okay? You need to find another way to recover your funds. Again, it is costly because a customer might go to the court, take some or put some injunction. Again, the bank needs to involve some other entities when it comes to selling of customers' securities. Okay. And lastly, the outcome of realizing the bank fund from selling of the security is not certain, because also there are some other conditions or economic factors. Okay, for instance, it's a house. Maybe people do not have a lot of disposable income to purchase those household motor vehicles, whatever asset that was paid. Okay, therefore, we are not 100% sure that indeed the bank funds can be realized from selling of the pledged security. That's the reason we prefer to rehabilitate the loan rather than going into the recovery phase. Now, what do you think can be the reasons for non-performing assets? In spite of the various mechanisms established by banks to ensure that customers meet their obligations as agreed, still some credit facilities are not paid on due date. The causes for non-performing loans can broadly be categorized into two groups. Number one, the internal reasons, and number two, external reasons. Internal reasons are such as deficiencies in loan origination. That is, there were insufficient financial information on borrowers, or borrower financial illiteracy, borrower has poor fund management, or borrower does not even a very good record keeping. Again, internal reasons can be due to unavailability of independent, verifiable credit information or credit history on the borrowers. In some other countries, for instance, the US, there are some credit bureaus, but one of the reasons for the massive default, in 2007, 2008, that led to the global financial crisis, was also misinformation from these credit rating agencies. So maybe it was intentionally, maybe it was due to lack of some past history of the borrowers, but this is the point is that this is also one of the internal reasons that can lead to high rate of default. Deficiencies or irregularities on collateral documentation can as well be one of the internal problems. Failure to accurately align loan products to borrower specific needs. For example, a borrower appears to you asking or in a need of short-term financing. Now, instead of giving the borrower the right product, you suggest the borrower something which is extremely difficult for the borrower to meet. For instance, your customer is in need of, let's say, 10 million Tanzanian shillings. Now, this customer has some invoices which are worth 35 million. Again, the very same customer has a bill of exchange which has a face value of 55 million. Now, the customer comes to your bank asking for a short-term facility, such as an overdraft or short-term business loan. Now, what do? You give a customer short-term business loan, which will run for 1 year at a rate of, let's say, 15%. So the customer is forced to borrow 10 million to be repaid in 1 year on monthly basis at a rate of 15%, while actually you could ask the customer to bring these invoices or to bring the bill of exchange, where you can simply discount these facilities in order to give the customer what they need. For instance, if you discount the bill of exchange that has a face value of 55 million or an invoice that has a face value of 35 million, it's very possible for this customer not only to get the 10 million shilling which the deficit he wants to cover, but something even higher. For instance, he might end up with 30 million in case of the invoice, or 50 million in case of the discounting of the bill of exchange. Another reasons, internal reasons, is the skill shortage. And this is the essence of training such as this one. Bank officers needs to acquire required training in order to equip them with the necessary skills that can assist them to correctly analyze financial statements or to correctly and accurately appraise a loan proposition. Because remember, these loans are accompanied with a number of documents, And all these documents need to be thoroughly scrutinized by a banker before a decision is made. Also, there can be lack of proper strategies and techniques for non-performing loan recovery, or a myopic view toward training and development, resources and time invested in enhancing skill vis-a-vis immediate concern of day-to-day running of the bank. And this is one of the major problem banks in Tanzania are facing. Like, a bank does not allocate time for the bankers to go out for training. Okay, so a bank and many banks will prefer bankers to go to work and maybe later in the evening to go and acquire these skills or knowledge from different training. Okay, but it will be much better if these bankers will be given a completely free time for them to go out for maybe a week or two and acquire some necessary training before they could return to their desk, so that they can be more professional, more efficient, and that way they can always keep the bank position. Now let's see external causes as the reason for non-performing assets. Number one can be macroeconomic condition. So here now we're talking of the entire economy. Now, what are the macroeconomic reasons that can lead to non-performing assets? Number one is recession. Okay, if the economy is not booming, everything is going down, then expect to have high rate of default. Rising in inflation rates, because rising in inflation rates, remember, inflation erodes seriously purchasing power of the money. That's number one. But number two, inflation or serious inflation really hurt the economy. So that way people won't have money to repay back their loans. Falling of the exchange rates. Okay, this is the currency risk. Tax increases. Okay, now tax, remember, tax reduce what? Disposable income. Okay, so if there is higher corporate tax or personal tax, then individuals will have less funds at their disposal, and so probably they won't be able to meet their loan obligation. Again, a rise in the level of unemployment can be another factor, because if you have a very good number of people without jobs, then there is no way these people will be able to meet their contractual obligation. And also changes in policies or in regulation within the country. Also, these can as well hurt everyone or all those people who are supposed to be repaid back their loans. Now, macroeconomic condition can as well be pinpointed to a sector, a specific sector. We call it sector specific. Okay, for example, increased competition between domestic companies and foreign companies. Look at the competition between banks, okay, in Tanzania, because also we have some domestic banks and foreign banks, and all these banks issues or offers products which are closely related. Sometimes it becomes difficult even for customers to differentiate products that are offered by domestic against those offered by foreign banks. Also, there can be some supply shortages, okay, because some other businesses will want, so let's say, equipments, tools, or spare parts from abroad or from overseas. All right, now, if for some reasons these spare parts or these tools are not available on time, it's going to be a problem. Demand fall can as well be a big problem because demand fall will ultimately decrease what? Revenues, okay? Now, if there is no revenue, it means at the end of the day, after tax profit will as well what? Decline. Now, without a profit, it becomes difficult for the borrower to meet their contractual obligation. Tax increase in the products that are imported or exported can as well be the problem. Now, what can give you a warning? What can give you a red flag of an impending default? There are some indicators, and once you see these indicators, you really need to take action. Number one, delay in receiving borrower's financial statement. Remember, there are some terms and conditions that the borrower needs to fulfill right before the funds are disbursed and right after the funds have been disbursed. Okay. Now, right after disbursing the funds, for instance, the borrower is supposed to be submitting periodically financial statements. That is the bank, let's say, balance sheet, income statements, and another statement that you require. Now, if the customer failed to deliver as planned, this should give you, or this should be a warning to you that probably there are some problems. Sudden change in accounting methods. The business decides to switch from a certain method that has been used for quite some time into a new method. That could be a technique of hiding, okay, some deficiencies in that particular business, so you should be aware of it. Significant deviation of actual from projected sales. Okay, remember, during the appraisal, we asked this borrower to bring what? The projected cash flow, and he brought them. Now you need to compare projected cash flow against the actual cash flow, okay, in order to see the difference. Is the difference positive or is the difference negative? If it's negative, what went wrong? What led to this negative? If it's positive, then how should it be improved, etc. So please, if you see that there is significant deviation from the projected cash flow, you need to take an action. Change of the management or auditors. Okay, a company that is stable and everything is safe does not change management team or auditors just like that. Okay, therefore, if there is a sudden change, okay, firing of people, employees, okay, it should tell you that probably there are some problems. Again, unexpected changes in the deposits. Remember, you ask the customer to route sales, okay, to a bank account that is maintained in your bank. Now, if there is significant change in the level of deposits, you should be aware of that probably the sales are not going as you expected. Last, irregular loan repayments or irregular operation of the account. So that I can as well tell you that probably there is a problem. For instance, you ask the customer to be making periodical repayment on every 25th of a month. And now the customer sometimes make it on 25th, sometimes on the 30th, sometimes even in the coming month, let's say on the 2nd of the following month. So this irregular pattern is not good. You should be aware that probably it's a sign that the customer is about to default. An increase in the number of debtors. Okay, probably the customer is overtrading, or probably the customer now is having a lot of funds as a credit. Okay, so he might have or experience some liquidity crisis. Piling up of stocks, meaning that no sales are made as expected. So this can as well be a sign. Accumulation of prepayments. Why will he do so? Because these prepayments can be used by the business for production or meeting some other business expenses instead of just making the prepayment for a good reason. Now, to conclude this, let's see the overtrading. Overtrading is a situation where a company does more business than what its finances allow. Okay, so the company is identified as that it is doing a lot of sales, while actually those sales or the assets that are supposed to finance those sales are insufficient. It is related to the cash position of the enterprise, and it occurs when the company expands its scale of operation with insufficient assets. Now, assets can be cash resources or any other physical asset that is supposed to assist the business into meeting its objective. It is important for a banker to be sure that the business so requested alone is not overtrading, because if the business overtrades at the end of the day, it will default. It won't be able to meet its contractual obligation. Therefore, in case of overtrading, business won't be able to repay back the loan. It is the duty of a banker to identify the signs for overtrading so that preemptive measures can be done before things get out of hand. Overtrading can be caused by any, if not, of the following factors. Number one, rising in prices or inflation, because remember, inflation simply means persistent increase in prices of goods and services, but actually inflation seriously erodes the purchasing power of the funds. Therefore, a serious inflation can be an indication, or a serious rise in prices can be an indication of the overtrading. High taxation, increased lockup funds in stocks. You have stocks in the shelf that are not offloaded to the customer, or sometimes you have a very good number of debtors. That means your money is out there with someone. Over expansion, okay, that means now you have overstretched. You cannot be able to meet the demand of your customers due to operating in a very, very big area with very few or absolutely no insufficient resources. So what are the signs of overtrading? Number one, increase in bank borrowings and loans. Okay, every time the customer runs to a bank asking for a loan or asking for a certain credit facility. Number two, persistent use of bank overdraft facility, increase in stocks, purchase of fixed asset out of short-term funds. Remember, fixed asset does not generate a profit in a short time. Therefore, using short-term funds to purchase or to acquire a fixed asset is a serious problem. Fixed assets is a capital expenditure. Okay, fixed asset is a capital expenditure. So you need another source in order to finance the acquisition of fixed assets. Decline in the working capital ratio. Okay, now how do we compute working capital ratio? If you know how to do it, then please compute that ratio from the submitted financial statements and see if the company or the business is doing fine or not. Decline in the rate of gross and net profit. Significant increase in the payable days and receivable days ratios. Okay, remember activity ratios. Okay, activity ratios, we have payable days. This is the number of days the business takes to repay the creditors, and receivable days refers to a number of days the business takes to collect. Okay, the business takes to collect funds from debtors. All right, therefore, if these numbers if these numbers indicate otherwise, you should be concerned. For instance, if the business takes a lot of time to pay creditors, it's a bad sign. Of course, every creditor will offer a business a specific grace period or a period that should lapse before the business pay back. Therefore, if the business pays within that period, it's acceptable, no problem. But now if it goes beyond, that is a problem. Now, When it comes to the number of days used to collect from receivables or from debtors, then we expect that if you collect your money from anyone who owes you in a short time, it's better than taking long, because you may run into some liquidity crisis, and liquidity crisis is not good for the business, because you want to be able to take advantage of some beautiful business opportunity that may present itself. How can you detect overtrading on the customer's account? Bank overdraft will develop a solid hardcore borrowing, and there will be no swing into credit in the account. This would eventually increase in size past the limit. The customer may start to issue post-dated check. There might be excessive beyond the overdraft limit each week or month to meet wages and salary bills, because the business has a lot of debtors out there. That means a lot of funds is not at the disposal of the bank. A lot of fund is tied with the credit sale, and therefore the business is expressing some liquidity issues. Now, these liquidity issues can lead for the business to never meet its short-term maturing obligations, such as payment of wages, salaries, utility bills, or purchasing some raw materials, etc. Paying some checks becomes a problem, okay? And also, the customer may start to pay trade creditors in round amounts, okay? A sign that they are being paid a certain amount on account, but are not being paid in full, okay? And last but not the least, bouncing check. Okay, the business issues a check, and when you go to deposit the check, that check is never paid. So this should tell you that this customer is overtrading. Now, what are the consequences of overtrading? Inability of the management to pay wages to the employees and taxes to the government, okay, because now the business is in liquidity crisis. Decline in sales and costly purchases, because eventually this business will fail to meet the demand of their customers who are in different areas. Due to what? Due to a lot of credit sale that was done in the past, and a lot of funds is out of the business. Okay. Difficulty in raising funds because of poor credit worthiness. Every time they ask for a loan, the proposition is rejected because they fail during the analysis. Problem with the debtors and creditors. Debtors has business funds. Creditors, business owe them some funds, all right? So creditors want to be repaid. Debtors want to be given some time before they could make payment. Now, since the business does not have funds, it pushes for the debtors to make payments even before time, okay? And it is doing so in order to meet the short-term maturing obligations, such as the repayment of the creditors. By doing so, the business might enter into conflict with both the debtors and creditors. Again, inability of the management to carry out timely repairs and maintenance, resulting in inefficient working, okay? Because some of the assets that are used for production or are used to facilitate sales, okay, needs to be maintained, needs to be repaired, okay? Some needs to be supplied with some new tools, and purchases of new tires, purchases of war spares, etc. Now, if the business cannot meet such a demand, okay, then that are implications of the overtrading. Lack of funds will compel the company to go in for outdated and old machinery for replacement purposes, because now that the business cannot maintain machines that are at its disposal, and it does not have funds either to lease or to buy new machines, then it will result into taking some old machines. Alright, and now that one is simply the consequence of overtrading, because by taking the old machine, the business won't be able to generate or to produce as it used to do before the problem. Now, the effect of overtrading arises from the fact that the business will face liquidity problems. Hence, the purchases cost rise because the business cannot take advantage of suppliers' discounts for paying early. It cannot pay early simply because it does not have money. It cannot take advantage of suppliers' discount for bulk purchases. Why again? No money. So it's all about liquidity crisis. The business buys on the basis of best rate available instead of best price basis, because due to liquidity issues it does not have cash to pay for items, therefore it have to go for credit. Cannot take advantage of special purchase opportunities and lower gross margin. The business sells on discount and sells for removing sale, right? The business needs to offer massive discount in order to attract some more customers so that it can maintain liquidity. But by offering massive discounts, some profit will as well what? Decline. There arises strained business relationship with the trade payable for not paying them on schedule. These are creditors. If you do not pay creditors on time, you will enter into the conflict with them. The business may try other expedients to obtain credit or raise more cash, such as factoring, invoice discounting, new loans, and sale of assets. Of course, if these initiatives are done in a good cause, there's no problem. But if they are not, then it's a big problem. Okay, so not all the time when you come across a business or an individual who want a factoring service or discounting service, you should think that they are facing overtrading. No, it depends with the circumstances. Of course, there are a lot of issues that you need to go through before you could confidently conclude that this business is overtrading. So the moment you meet a customer who wants to discount the invoices, please don't conclude that they are into a problem. Badwill may arise by pressure on trade receivables to pay more quickly, because when you sell on credit, you expect that those customers will pay, let's say, within 30 days, right? But now, due to liquidity crisis that you're about to face, now you're forcing these customers to pay, let's say, within 10 days, 15 days, or even 5 days. Now, these can bring conflict between you and these customers. Okay. Now, again, the business may face some difficulties when it comes to paying taxes, wages, and salaries. Now, failure might lead into total collapse of the businesses. Therefore, some remedies, some actions need to be taken immediately in order to save these businesses. So, as a banker, what should you do? You need to advise the customer, all right, to do the following. Number one, to cut down its business and overspending, or to inject some more capital in order to save its business. Number two, to reduce inventory levels. Okay. Three, to hold back the pace of revenue growth until profit margins and cash reserves have been improved. Please, rather than buying capital equipment, because capital equipment are so expensive, so it's much better you lease. You'll be paying these rentals, which are cheaper, rather than deciding to purchase a capital equipment due to the amount of fund that will be involved. If you lease, for example, if an asset is sold at, let's say, USD 100,000, okay, if you want to buy, it means you need to pay this entire amount. But leasing the very same asset, maybe you'll be paying this rental of 2,000 a month, which means you are left with a lot of fund at your disposal that you can use for some, or to run some other operation of the business. Again, look for suppliers that can give you better payment terms or credit terms. and also enforce better payment terms with your debtors, with customers who want you to sell them on credit. Now, gentlemen, ladies, that marks the end of this evening presentation. I appreciate for your patience.